Good afternoon and welcome everyone to Treasury Lab 3 today. Today we will be discussing how to increase visibility and efficiency in risk management with your Treasury technology. My name is Jacqui Drew and I will be the host for today's session. As uncertainty and complexity are increasing in the current environment and more generally today, risk management is constantly being prioritized on the Treasurer's agenda. Today, I'm delighted to be joined by Rob McAnally, the Group Treasurer at Associated British Foods, and he will be discussing how he is using technology to manage his financial and commodity exposures. From a housekeeping perspective, we will be taking questions from the audience towards the end of the session. So if you do have any questions, please feel free to post them in the session at the bottom of the screen. But to start with introductions, as I mentioned, my name is Jacqui Drew and I run the sales and account management team for ION Treasury for the EMEA region. This includes generating new business across the region, but also managing our 500 plus accounts in the region that are using our treasury management solutions. To introduce ION, ION is a leader in financial technology, automation, and data. We provide mission-critical trading and workflow automation software solutions to over 8,500 organizations across the globe. Specifically for the corporate market, we offer treasury and risk management solutions and commodity trading and risk management solutions to over 2,300 customers serving 80,000 users. And you can see these two communities on the bottom left-hand side of the screen. Specifically, you'll be familiar with many of our products and brands within these two communities that are serving the corporate market. On the left-hand side of the screen, you will be able to see our commodity and trading risk management solutions. And these solutions are really diverse in terms of the end user, so who's actually using the solution and for what purpose, but also in terms of asset coverage and their functional profile. On the right-hand side, you can see the treasury solutions that we offer, which again are diverse in terms of end-to-end treasury and risk management functionality, abilities to customize and configure functionality. Many of these solutions have different deployment preferences, so we are able to provide our customers choice in terms of how they want the solution deployed, what coverage they are looking to achieve, and scalability to match their desired end states. To complement this portfolio of products, ION is heavily invested in developing value-added solutions, and you can see many of these at the bottom of the slide. Latest innovations include machine learning on the treasury side for cash flow forecasting, and on the right-hand side, live market data feeds and analytics to support pre-trade pricing on the commodity side. In addition to actually offering solutions, we also offer services to our customers, whereby we are helping to educate our community of users on market insight sessions, as well as supporting our clients through regulatory changes like the IBOR reform. I would now like to introduce Rob from ABF, and if Rob, you can provide an introduction to ABF and an overview of your responsibilities, please.
Sure, thanks, Jacqui. First of all, hi to everybody listening in. ABF, or Associated British Foods, for those people who are not particularly familiar with our organisation, it's a diversified international food ingredients and retail group with some 16 billion of sales, 138,000 employees, and operations in 52 countries around the world. The business is split up into 5 segments. So we have grocery, sugar, agriculture, ingredients, and retail. The businesses, as you can probably see, have quite different characteristics in terms of sector, operating margins, competitive pressures, their geographic footprint, their working capital and capex requirements, and then also their currency and commodity exposures. And it's in that context, actually, that Treasury attempts to provide treasury services to the diverse group of businesses that we have within our organisation. So the treasury function within ABF consists of 10 people at the centre, and then a further 15 individuals in satellite treasury functions in various cities across the globe. So the responsibilities of treasury within ABF, I think, are pretty consistent with what you'd see in many other large organisations. So a prerequisite is ensuring that we have sufficient funding to meet the ongoing requirements of the business. We're responsible for the financial and commodity risk management, the day-to-day provision of liquidity through cash pooling, etc. Significant input into M&A activity, and then also very close collaboration with our insurance, pensions, and tax teams. So that's
Brilliant.
a brief synopsis.
Brilliant. Thanks, Rob. So very busy covering all of those different areas. So as I mentioned in the introduction, so uncertainty, complexity abound in the current environment. I think they're definitely exacerbated in the current environment. But can you perhaps provide an overview to the audience in terms of what are the main risks that your company is exposed to? You mentioned there financial and commodities, and obviously you've got your 5 different segments. But what are the most important risks that the organization is exposed to?
Well, I think the incidence of this black swan event, as we're all referring to it as, the global pandemic, has sort of highlighted to many organizations what their key risks actually are. And having probably put in place lots of business continuity plans and mitigating controls in the event of certain events happening, I think they've sorely been tested. From our perspective, like many treasury functions, liquidity became our utmost priority, particularly when we found out that the Primark's entire estate of stores was going to be shut, and with no real understanding about when it might open again. So liquidity was of a higher priority than anything else. However, having said that, we're also focused on the financial and commodity risk, particularly in relation to understanding what trading might look like in light of this pandemic, and whether the forecast exposures that the businesses were predicting would be a realistic reflection of actual trading behavior. It's fair to say, however, that actually I don't think the priorities necessarily changed. I think the pandemic just re-emphasized their importance. So it is liquidity, is financial commodity risk, and then there are a number of other risks which I think many treasury functions might tend to sort of deprioritize or put on the back burner. But I think things like controls and cybersecurity are of utmost or paramount importance to us.
Great. Thanks, Rob. And so just to elaborate a little bit further on that, so you mentioned, liquidity risk and being able to, I guess, ensure that you had sufficient funding and looking at your cash flows, and then also mentioned financial and commodity. So maybe just to delve into those 3 a little bit more. So on your liquidity risk, in terms of the time horizon, did that change, during the pandemic in terms of the original time horizon that you were looking to manage for your cash flows?
No, not necessarily. I think cash has always been king within any organization. As I say, I think the pandemic just re-emphasized those things. So we became more accurate on short-term cash flow forecasting than we've ever been, and we've continued that through as a result of the diligence that we've instilled in all of our businesses. And that's not something that's particularly straightforward in an organization that's as diverse as ours. But nevertheless, where there's a will, there's a way, and that's something that we've been able to implement and as I say, continue. With regards to longer term liquidity, I think, like any organisation, we're required to provide going concern statements and viability statements, which is something that you do going concern at each half-year reporting and viability statement at the end of the financial year. It just so happened that just as we went into lockdown, we went into our half-year reporting process. So what was at the forefront of our mind was demonstrating that we could state that we were a going concern for the foreseeable future. And so it was an ability by us to be able to demonstrate in probably what's been one of the most significant black swan events we'll ever experience, and let's hope it is the worst and get it again. But that we were able to demonstrate our resilience within the group and demonstrate our ability to forecast our liquidity out to at least 18 months, but indeed longer.
Brilliant, brilliant. And then on the financial and commodity risks, so I guess on the financial, probably your FX exposures, you mentioned operating in over 50 countries across the globe. So I imagine that's pretty significant. Any interest rate exposure? And then on the commodity side, do you want to just talk through a little bit about the commodities that the business is exposed to?
Yeah, sure. So we track within Treasury, we track 36 currency pairs that have the most impact on our business. There are unsurprisingly, 3 or 4 currencies that actually that we actually track most closely, and the ones that are actually most significant to the profitability of a number of our key businesses. So unsurprisingly, they're sterling as a sterling reporting entity, dollars, euros, and then we have a number of other currencies. Aussie dollars is particularly relevant to us, but then we also have some currencies that may not actually at first glance be of relevance or importance to us, but things like Thai bahts, for example, is also significant to us. We manage our currency exposures by virtue of ensuring that we have central policies in place, which Treasury sets out, and then we work closely with each of our businesses to ensure that they're managing their exposures in a way which is consistent with their business. When it comes to commodity exposures, because of the nature of our business and the diversity of our businesses, we have exposures to some fairly diverse commodities. So it ranges. Like sugar, we're one of the biggest sugar producers in the world. We have exposure to things like cotton through Primark and their garment purchasing. We procure over 3 million tons of wheat around the world a year in various countries. We have quite significant exposures to edible oils in the States through one of our bigger businesses there. Significant amount of energy exposure. We procure meats for a business called Don's down in Australia. A whole host of different soft commodities for the likes of Jordan's, Dorset, Ryvita, and those guys. So it's quite a big mix.
Big exposure and big diversity across those businesses as well. So thanks very much, Rob. So in terms of your technology landscape, so when I gave a brief introduction to ION, I mentioned that we have solutions kind of on the left-hand side that covered the commodity trading and risk management, and then on the right-hand side, treasury and risk management. And actually, we have one solution that straddles both of those areas, which is OpenLink, and it's the TMS and CTRM solution that you use. But can you maybe just provide an overview to the audience about your treasury technology landscape, and particularly focus in terms of how you're managing these risks?
Sure. So we host OpenLink on our own servers on our server farm as part of our shared service center for IT purposes, and we link directly through to Swift via Swift's Alliance Light 2 product, and that's something we've done. I think we've had it in place now for nearly 2 years. We then have data feed links into OpenLink that provides intraday data uploads, and we have a connection to 360T's FX trading platform for FX hedging purposes. We originally went about quite a detailed review, which took quite some time in determining what kind of treasury platform that we wanted, and because of the nature of our organisation, the various financial exposures, but then also commodity exposures that we were exposed to, we ultimately made the decision to go with a platform that actually could integrate both financial and commodity risks. And I'll come on to a little bit about why we did that later. But we did it with the foresight, if you like, of wanting to be able to harmonize our risks within one platform ultimately. Not something that we currently do at the moment, because a lot of our commodity risks are managed by disparate or separate systems or models, which is, I think, a euphemism for bloody big spreadsheets with VBA coding embedded in them, some of which, unfortunately, I have to admit I'm responsible for. which are used to manage the different commodities around the group. And so it's in light of that that actually we went down this route of actually selecting a platform which would allow us to integrate those different asset classes or those different risks within the same trading or risk platform.
Great, thanks, Rob. And you mentioned there about having a lot of spreadsheets with a lot of complex VBA calculations in the back end. I think just also interesting is the dynamic that you spoke about there of being able to bring your financial and your commodity exposures together. I think we've definitely seen kind of an evolution over the last 5 to 10 years, where historically and still in quite a number of cases, procurement is responsible for hedging commodities, and that's kept separate from Treasury. But over the years, there does seem to be a tendency to bring those two together, and as you say, having that holistic view. So can you maybe just talk a little bit about in terms of how you're hedging your commodity price?
Yeah, Jacqui, hopefully
is that the same?
Hopefully you can hear me. I think you
yeah.
It just, I think the recording just broke up a little bit there, but hopefully I understand your question. So in terms of of why we went down this route and how we go about actually managing it, I think it's worthwhile sort of highlighting, that when you look at correlations between financial and commodity risk, and a useful example would be the strength of the dollar versus the oil price, for example. We know that they are linked to some degree, and actually, depending upon what piece of historic data that you choose, will depend upon the level of correlation that you can demonstrate between those two particular asset classes or risks. Within our organisation, we've got some pretty peculiar commodities that actually, the way in which one manages commodity risk, it's not, you can't choose the same approach across all different commodities. And a useful example of that would be to say, managing wheat risk in Australia, and even within the same asset class. So even looking to actually manage wheat risk in Australia compared to, say, in the UK or the States, it is actually quite different because of the nature of the market in that particular region of the world. And so, for example, in Australia, wheat price risk we manage very closely in relation to the impact that East Coast drought in Australia has on the price of wheat in Australia. In Australia, they export, I think, in excess of 4/5 of their wheat production every year. It's a high quality wheat used for bread making. But if they have an East Coast drought hedge, then actually it can often be cheaper to actually ship wheat from the States into Australia than to move it within the country. And so it's in light of that we manage wheat in such a way that we're particularly managing that through things like basis contracts. And you can create those synthetically by selling CBOTs, so Chicago Board of Trade futures, and buying ASX, so the Australian wheat exchange, and then hedging the currency element of it. And that is completely different to how we manage it in the UK. Correspondingly, things like sugar prices. Sugar prices are driven quite significantly by the amount of sugar that's produced in Brazil, because they're the biggest sugar producers in the world. And Brazilian sugar price is linked to the Brazilian real US dollar exchange rate, and also the price of oil, because the Brazilian sugar producers produce either sugar or ethanol. As they've got fully flex fuel cars in Brazil, so they can either stick petrol in it or they can stick bioethanol in it, and it doesn't matter. The cars there run on both. And so depending on what's most profitable, the Brazilian sugar producers will produce one or the other. So that drives the price of sugar quite significantly, along with the exchange rate between the real and the dollar. So when you start to look at those things, it becomes quite complex. And we're one of the biggest sugar producers in the world, and we want to obviously manage our sugar price sales risk. So it's actually looking at those and saying, you've got you've got oil prices, you've got an exchange rate, real dollar, you've got the sugar price, which is influenced by both of those, and then you've obviously got translation risk in terms of which particular jurisdiction it is that you're producing and selling sugar in the first place. So it's in light of that we were looking to see if we could harmonize the different risks and take account of the correlations between them. And one can't do that in a computationally time efficient manner if you've got the different asset classes sitting in separate databases. So it's in relation to, well, it's in light of that you then say we need to have something which actually allows you to run computationally time efficient analysis, taking account of the different correlations, by virtue of having that data within the same database. So that's the ultimate end game. Where we are at the moment is that we have financial risks managed within our TMS, within OpenLink, but we are quite some way away from being able to start to pick off the different commodity risk management exposures, if you like, that we've got around the group. And as I say, they are quite different to procuring meat in Australia or wheat or edible oils in the States or energy costs and this sort of thing across the group. And it's doing it with each of our divisional businesses and our satellite treasury functions and picking them off one by one, where I describe it a little bit like switching the lights on. So bit by bit, you start to get contemporary visibility of your exposures, and then also of the derivatives that are being managed derivatives that are used to manage those exposures. So it's not a big bang approach. It would be physically impossible to do that within our organization, but we are certainly some way down the line in terms of being able to get visibility of our financial exposures. It's the commodity piece that comes next.
Brilliant. Thanks, Rob. And you kind of led me on to the next question, which you've highlighted already, but just to recap. So what would you indicate as kind of the key benefits of being able to have both of those in the same single solution? You mentioned visibility a couple of times, but anything else that you would envision being key benefits of having both those key risks in the one solution?
Well, yeah, so we've spoken about being able to run computationally time efficient analysis. What you get out of that, and it's something that's difficult to actually articulate until you've got your hands on the data, but once you do, you then start to be able to understand whether or not you're actually whether you've got an efficient hedging program by virtue of managing exposures in a disparate and separate way. If you're able to look at the correlations and able to take account of those, you can then determine whether or not you're actually, if you're hedging efficiently, or if you're over hedging, or if you're under hedging by virtue of treating them as separate asset classes with no correlation at all.
Yeah, brilliant. Great. And so, Rob, we've spoken about liquidity risk, financial, commodity risk. One of the other key risks I imagine the organization is heavily exposed to is around your counterparty risk. And understand that you've taken quite an innovative approach in terms of how you're managing your counterparty risk that the organization is exposed to. Can you shed some light on what the team's been doing here?
Yeah, certainly. So counterparty risk, the way many treasury functions will actually manage that is by looking at the long-term credit ratings of their banking counterparties, and they want to do that in light of the cash that they might have on deposit, and all of the derivative positions that they have outstanding in relation to those in relation to those banking counterparties. And some of the mark-to-market values of those derivative positions could be significant, particularly if you've got large swaps in place. Long-term credit are not a contemporaneous measure of the risk that one's facing with regards to a counterparty. And so what I wanted to do was to be able to actually use more contemporaneous or real-time measures of risk, and actually build that into an algorithm that actually calculated it on a live basis within our Treasury platform. So that's something that the Treasury team has done here, and we've had in place for, I think, just over 18 months now. And in essence, what we did is we took, if you like, real-time measures of risk, such as credit default swap spreads, and we used those to determine a probability of default for each of our counterparties by using the output from two specific algorithms. There are only one of a number of them that you can find in the marketplace. What we did is we combined two of them and actually weighted it slightly towards the output of one which produced slightly more conservative results. We then took measures of a bank's financial viability, if you like, so things like tier 1 and tier 2 capital, to build up essentially a headroom calculation, well, a counterparty limit, if you like, per bank. And based upon that, we're then able to compare that with, as I said, all the cash, all the derivative positions that we had outstanding, to actually then work out what the remaining headroom was per counterparty. And as I say, that's calculated dynamically within our system on a daily basis. We then use that headroom data, and we actually used that as part and parcel of the derivative, the FX derivatives that we're looking to trade on any given day or at any moment in any given day, whereby we do a VAR calculation on the block of trades that are about to transmit to 360T. And if that VAR calculation exceeds the remaining headroom for a given banking counterparty, it switches that bank off in 360T from being able to actually participate in competing for those trades at that particular time. Then what we do at the end of the day is we rebalance our portfolios so that if we need to reduce the amount of assets held by one bank, and we have that ability, then we'll do so that they're then able to participate the following day. But in that way, we're able to dynamically manage our counterparty risk. And when you actually have quite significant assets, whether it be cash or derivatives, it's quite important to ensure that you're looking at the contemporaneous measure of risk. And when you look at the CDS spreads for the banks over the COVID shutdown, they spike significantly. So it demonstrates how quickly it can change.
Yeah, and I think just listening to you as well, I think that's the key thing, isn't it? So having a much more dynamic approach on the one hand, but also really ensuring that you're responding to what's happening in the marketplace. I guess we're not seeing the ratings change as dynamically and as quickly, but you see that coming through in the CDS spread. And so would the intention be to kind of extrapolate that across your commodity exposures and your risk management on the commodity side as well?
I think to the extent that we're able to, the answer is yes, and it's something that we've already discussed. Each of our businesses is clearly responsible for its counterparty risks, and having great credit controllers in place. We work extremely closely with our procurement team, and we can do that because of the way in which we're set up in terms of setting the policy around both, as I said, financial and commodity risk. But in fact, when it comes to counterparty risk within the commodity world, it depends upon the data that is available for you to be able to then do that assessment. In the case of banks, it's very straightforward. In the case of other counterparties, it's less so. To the extent that we're able to utilize the same or similar technology, we fully intend to. So even things like putting margin deposits down and having daily margin calls when you're trading commodity derivatives, whether it's futures or options, it's that area as well that we're particularly focused on to ensure that businesses are very much focused on the risks that they're bearing by virtue of their particular business.
Yeah, absolutely. Great. Thanks, Rob. And so in terms of, if we look at overall risk and the uncertainty in the current environment, and just looking at your technology landscape, what are the kind of the key projects that you'll be looking at over the next 12 to 18 months from a technology perspective?
Sure. One of the things that we just about completed prior to going into lockdown was we were building, is something that we did internally. We were building the technology to actually embed IFRS 9 into our platform, and we were doing it for financial exposures first, before then embarking on the commodity side, which is somewhat more complex. So we intend to finish that, ensure that it's embedded in our platform so that we get full rollout across the businesses. By virtue of encouraging our businesses then to utilize that, it then enables us to see, we then get the visibility of the business's underlying exposures, because clearly you need to put those in order to be able to seek hedge accounting. And we seek hedge accounting on all derivatives that we take out, unless there is a specific reason why we're not able to. It then also means that you've got the derivatives that you're actually using to manage that risk embedded in the system. So you then get much better clarity and real-time visibility of those exposures or risks and the derivatives that you're using. So that's going to be one of the first things that we get back to in terms of our agenda. We've got a system upgrade to do, which was something again that was put on hold, but we intend to get that completed in the next few months. We've got the inexorable Swift attestation to complete this year, which we're now on the treadmill of doing every year. But I think it's something that for security, cyber security is critically important. We're going to be rolling out then the platform across our businesses so that they're all utilizing it. And then we have the first foray into our commodity risk management process that we're going to be embarking on with our colleagues down in GWF, our Australian divisional business. And we've got a project to develop the commodity risk management tool firstly for wheat, actually, for our milling and baking business down there. And that's going to be broken into several components. So clearly one component is around the actual commodity risk trading tool, which is going to be replacing a VBA-based model that was developed actually by some consultants after I forced them into replacing the tool I helped develop many years ago, and that was last legs. And then also, as part and parcel of the milling business, we need something whereby we automate the logistics handling piece, and that will go hand in hand with the commodity risk piece, and they should be inextricably linked. And it gives us much better visibility of tracking wheat, how it's being handled, how you therefore manage the wheat price risk. So that'll be our first foray into the commodity risk side. But they then want to use it around their their meat procurement, and we'll also be looking at it for the next one after that would be edible oils in the States.
Great. So you kind of got your roadmap of which ones you want to target, kind of going back to your earlier point about, switching on those light bulbs and getting them each implemented.
Yep.
I guess the ultimate goal, as you said as well, would be to be able to look at those correlations. So you gave the example of, sugar, Brazil driving that market, but how it's correlated to the underlying FX and other prices. And I think, longer term, that must be your vision of being able to ascertain those correlations across those different asset classes and FX and interest rate pairs.
Yeah, absolutely. And as I say, it gets rid of, I've always perceived it as key systems risk and key man risk, because you get less and less people who can understand how the models that we developed many years ago are working, and certainly can't be developed further. So it's a matter of actually bit by bit replacing those things, which actually present quite significant business risks if you're not careful, to business continuity.
Yeah, absolutely. And I guess also being able then freeing up your team's time to be able to interact more with your partners internally within the business, but also with your stakeholders. So fully packed agenda. I think you had mentioned a couple of other things as well when we spoke about, IBOR transition also coming and the impact of that. And then also the changes in the UK market with moves from RPI to CPI. So quite some significant key changes coming up on the horizon. Great. So we've just got we've got some questions that are coming through from the audience. Actually, I'm going to take those now before we look to do our wrap up and closing comments. One of the questions that's come through, Rob, and you did touch on it at the beginning, but maybe just to recap if anybody joined a bit late. But the question is, how have your risk management policies changed as a result of this year's events, particularly around the length of cover that you are hedging?
Yeah, as I articulated before, I don't think they've really changed. They've just re-emphasized the risks and the priorities of risks within our organization. I think in terms of length of cover, again, I think it's an interesting one actually, because I think you have to look at the prevailing market circumstances in which your businesses are operating in to determine what the most effective management of risk is going forwards. And so, depending upon the business, I think the maturity profile of your cover of your risks or exposures can change because you might just have less certainty about what the future holds. And certainly, I think that depending upon the business, you've certainly seen an element of that taking place. In fact, you might have even seen for certain businesses, depending upon the sector, a unwinding of certain derivative trades based upon your forecast exposure because of the impact of COVID. And so it's in relation to that actually you need to be very very mindful of the changing or prevailing market circumstances. And so it's not a one size fits all within our organization by any stretch of the imagination. We work very closely. We often sort of describe ourselves as business partners rather than treasurers, actually. And we work very closely with each of our businesses to actually determine what is an appropriate course of action, whether we need to unwind any trades or whether or not we need to actually swap them out to longer dated periods.
Brilliant. And the next question is kind of related to that, actually. So what would you have done differently, if there is anything, in terms of mitigating your financial and commodity exposures when the pandemic first hit?
Yeah, that's an interesting one. I'm speaking at a session in a couple of days' time, actually, which one of the principal questions is that. So it is a really interesting one. With perfect hindsight, one would possibly say that you should be using derivatives with asymmetric payoffs, so i.e. options, because it gives you the downside protection as well as some of the upside opportunity. But unfortunately, that's not the way in which the world works. You don't have perfect hindsight. And in reality, options have their place in terms of a hedging program, but you would only use them depending upon the implied volatilities that are prevalent in the particular market that you're operating in. Whether it be interest rate or FX derivatives, or whether it be different kinds of commodity derivatives. And I certainly, even with perfect hindsight, if I go back and say what kind of hedging would we have used for a particular exposure, unless options were the right thing to use at that time, I wouldn't have suggested that we change the way in which we manage our risks, because options can be quite expensive if you use them inappropriately. So I'm not sure that we would have done much to change the way in which we manage our exposures. As I say, we don't have perfect hindsight goggles on, so it's physically impossible to actually to pick the best instrument for that particular time. But I think it's testimony to the fact that yes, we did have to unwind some trades because actually the forecast exposures were looking highly unlikely, given the impact of the pandemic on operating conditions for some of our businesses. But I think it's testimony to the fact that we haven't really changed the way in which we go about managing the risk. Yes, the hedging profile might have changed to some extent, but that's it.
Yeah. And I think that I was listening to one of your previous talks that you did with the ACT on BCP and the planning and everything that you've done as an organization to be prepared on that. And one of the things you mentioned was, key thing is being able to be flexible and adapt. So yes, you can test lots of different scenarios and create what-if analyses, but it's how quickly you can adapt and overcome whatever happens. And it sounds like you're saying on the financial commodity side, it's sort of a similar approach.
Yes, I think that's exactly right, Jacqui.
Yeah, great. And just coming back to, obviously with ABF having, exposure in those 5 different segments that we spoke about, sugar and on the retail and the groceries, ingredients, how do you kind of keep oversight of all of that and be aware of what's happening within the organization, what's happening in those markets? What's really key for you to be able to have that coverage and control over those different aspects?
I think you'd like me to say, or you'd expect the answer to be systems, but at the moment it isn't, because we're not. The intention is absolutely to be there and to use the system. We often use a phrase which is called a single source of the truth. And by virtue of having everything in the system, it then gives you that single source of the truth. At the moment, it's down to the business partnering that Treasury and my colleagues within Treasury have with each of our businesses, and to some extent the reliance of the business on our expertise that we provide them, which means that we have very close contact with each of the businesses. So we're very, very well aware of what's going on and the exposures to which they're exposed to, as well as their derivative positions, aligned to internal reporting, which means that we've got pretty up-to-date, if not contemporaneous, visibility of the data.
Yeah, brilliant, great. Excellent. And you mentioned there a few times as well about the business partnering, and I think that's a really nice way of explaining the role of Treasury within the organization, and you being able to connect in with your partners within the wider organization. So just any kind of closing comments for any treasurers in the current environment, particularly around, I guess, the risk management, and how to ensure that you have good control over that.
I think it comes back to everything that we've just spoken about, actually, Jacqui. So it's visibility, it's understanding your exposures, and also the changing dynamics of the businesses that you have within your organisation, such that you're close enough to them to understand when they're going to have to do something that's different or revise their hedging and maturity profile. The business partner is critical. I think also one has to recognize that it depends on your risk management objective as well. If your objective is to minimize earnings volatility, and that's certainly one of our objectives with regards to managing risk, then you've got to look at it over the long term. You're never going to get it right all the time, but if you're looking to minimize your earnings volatility, it's minimizing the spikes and troughs, if you like, in whatever particular exposure that you have, so that you get consistency of earnings, and ultimately, ideally, provides you with a little bit of a march on competitors within that particular sector, because you're able to actually plan for the long term and not think about short-term volatility and shocks to your business and its performance.
Yeah, brilliant. That's great. Thanks very much, Rob. And there's just one final question that's popped up, and then we'll look to wrap up. So you mentioned about your kind of risk management strategy and what you've been focused on, and particularly as the pandemic hit, you were in half-year review. Now you're at year-end review. Anything key that you're doing differently as part of the year-end review?
No, actually, I don't think there is. I think everything that we actually experienced, learned through a fairly sort of stressful set of circumstances stood us in good stead for the future. So we've demonstrated in spades the resilience of our organisation. I do think that actually, with regards to, I guess, just reviewing the existing position that businesses portray in terms of the exposures and their maturity profile, is just actually sense checking those and actually challenging them on their logic to see whether or not it stacks up or not. For us, I think it's a diverse portfolio of businesses, and therefore you've got to have quite different hats on depending upon which business it is that you're actually speaking to. But other than that, no.
Yeah, brilliant. Well, I'm sure it keeps it very interesting and keeps you all on your toes. But thanks very much, Rob. So we've come up to great. We've come up to the end of the session. If there are any other questions, then feel free to reach out to either Rob or myself, and very happy to answer them. But thank you very much, Rob, for your time today. Really valuable insights, and I'm sure the audience has learned a lot from you. So thank you for your time.